Your market news now. Asian shares rose in line with Wall Street's high note, and bonds also rallied, boosted by dovish Federal Reserve comments, while oil prices edged down after yesterday's surge, with the market remaining focused on the conflict in the Middle East. The market's initial reaction to the geopolitical developments in the Middle East was a bout of risk aversion. Meanwhile, the dollar has steadied after an earlier advance as odds for another Fed tightening eased. Gold is little changed, and locally paper and pulp manufacturing giant SABC says it has rather started talks over the possible closure of its Belgium-based Lanaken mill as it forges ahead with its strategy to reduce its exposure to the graphics market. To give us more perspective on the markets, we are joined by Martin Smith, who's a portfolio manager at Anchor Capital. Martin, thank you so much for your time. I mean, there's quite a lot happening, whether it was the bond market developments last week and geopolitical tensions this week. How's the market, reacting as we move from one event into the other?
Yeah, you're absolutely right. There's a lot of noise and a lot of things on the go. I think the main thing at the moment is based around the Fed. I think you spoke earlier about kind of as news around the conflict came out, you saw a bit of a reaction in the market, but again, market turned its attention very much to the Fed and the fact that we might not see that 25 basis point hike come through. So I think all eyes on the Fed for now, but definitely keeping an eye on the other developments, which among others include the conflict.
We'll get to the Fed in a moment, but I just want to talk about some of the movements we saw last week in bond yields. Have we reached the peak as we look at long-dated Treasury yields? And if so, what does that then mean for the market?
So I think for now, base case is that we are very close to, if not kind of at peak levels in those yields. As that starts to kind of abate, it's a lot more constructive for equity markets. So obviously that has an impact and a kind of impact on the valuations of equities and the equity market itself. So again, if we are towards the peak and as that starts to come down, it's very constructive for equities and the equity market in general.
So taking into account what we heard from some of the Fed officials, the question then becomes, does the Fed still need to raise rates again, or has a lot of their work been done by the market?
I think it's more probable than not that they're going to kind of keep rates where they are. That's kind of where the probability is lying at this moment in time. But I think the big thing that the market's actually more concerned about is how quickly rates come off. And I think that's what you saw a few weeks ago when you saw that sell-off sparked on the fact that Fed indicated that you only see 0.5% worth of interest rate cuts next year, as opposed to the 1% the market was kind of hoping for. So I think whether we see another 25 from here, I don't think it's massively market moving. I think it's more about how quickly they come down. But base case, they don't hike from here.
Speaking of how quickly they come down, we've been hearing a lot about this higher for longer narrative. Does that mean in 2024 you've pushed out your rate cut scenario? Is it more to the second half of the year that we could see some cuts?
Absolutely. So I think our base case and I suppose market consensus was always around the second half of next year being the time that the Fed starts to kind of cut rates. But back to what they spoke about a few weeks ago with the Fed's kind of minutes that came out, is that it's not really going to be in line with what the market is expecting. With markets expecting the second half of next year, you'd have a 1% cut in interest rates. Fed is now saying that it'll only be 0.5% kind of by their dot plot kind of analysis. So that's what got the market kind of upset last year. What's
the biggest question for central banks right now? Is it about how quickly you take your foot off the pedal when it comes to those interest rates, or is it something else?
I think it's same as it has been, the balancing act of growth and keeping your economy relatively going and keeping inflation under control. So it's how much further they need to push, and you've obviously got lag effects of interest rates and how long do they take to come into play, usually around 6 months. And you've also obviously got things like external shocks. So for example, this conflict that we mentioned earlier, does that impact oil? And that obviously has potential inflationary kind of pressures that come into play. So it's balancing growth with against inflation, and also keeping a very close eye out for things like other shocks in the system, like I said, oil.
Speaking of those shocks in the system, and let's tie it in with some of the geopolitical tensions that we're seeing here, is there space in the market where investors can find some kind of margin of safety here?
So like I mentioned, you could make a constructive or bullish kind of case for oil from these levels. But I think the safest place at the moment would be USD cash. I mean, you could also make the argument for gold, but you've obviously also got a stronger dollar, higher for longer interest rates, which aren't really constructive towards the gold price. So remains to be seen how that'll play out. So I think the safest place to be would be USD cash at this moment in time, should things progress.
Are there sectors of the market, just quickly before I let you go, that have
Sure.
performed to the upside?
So again, sorry, I sound like a broken record. Obviously, you have that oil trade to come through, but I think the market isn't really being too much impacted by the geopolitical tensions, keeping a very, very close eye on it. But insofar as what the market's been impacted by, it's more around the Fed and the potential for no hike from here. So you've seen a little bit of buoyancy across the board, specifically on the tech side of things. And again, that's more around the Fed as opposed to anything around the conflict at this moment in time.
All right, Martin, let's leave it there. Thank you so much for your time. That is Martin Smith, who's a portfolio manager at Anchor Capital. That is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.